You are tuned into The 5-Minute Signal, Business and Wealth. I am Vivian Thorne, economic strategist. This is not a finance podcast. This is a blueprint for building and defending your economic fortress. We don't do speculation here, we do strategy. 5 minutes on the clock, let's get to work. The news today is defined by a deceptive silence. It is Monday, February 16th, 2026. The New York Stock Exchange and Nasdaq are dark for President's Day, and the East remains quiet for the Lunar New Year. While the average retail trader takes the day off, the institutional machine is grinding through a massive rotation. Last week, we saw significant sell-offs in software and real estate services, triggered by a sobering realization: the AI honeymoon is over. Investors are no longer just looking at what AI can do, they are looking at what AI is destroying. Specifically, the share prices of wealth managers, legal services, and logistics firms are being repriced as the market acknowledges that AI turns once scarce expertise into a cheap, abundant commodity. Why it matters is simple. We are witnessing the transition from AI as a speculative growth story to AI as a margin compression reality. When expertise is commoditized, the moats around traditional service-based businesses vanish. This explains why the Nasdaq has struggled, while the blue-chip Dow and emerging markets have seen a surprising influx of capital. The smart money is moving away from companies that sell human-led processes and towards those that control hard assets or essential infrastructure. If your portfolio is still heavily weighted in traditional software as a service or professional services, you are standing on a beach watching the tide go out. The hard truth is that productivity gains do not always equal profit gains for the investor. While a company might use AI to replace 15% of its workforce and increase output, the resulting race to the bottom in pricing often means that the customer wins while the profit margin and your dividend shrinks. Conventional wisdom tells you to buy the dip in tech. Strategy tells you that some of these dips are not temporary pullbacks, they are permanent structural devaluations. The cognitive replacement era is here, and it is ruthlessly stripping the value from middle management-heavy industries. If you cannot prove your business model survives when the cost of expertise hits zero, you don't have a business. You have a ticking clock. The actionable move for this week's landscape requires 3 tactical steps. 1. Audit your moat exposure. Identify any holdings in your portfolio that rely on charging for human-intensive data processing or basic professional advice. If they haven't integrated a proprietary, non-commoditized AI strategy, reduce your exposure. 2. Capitalize on the liquidity lull. Use today's market closure to set limit orders for European and emerging market ETFs. With the US dollar softening and capital rotating away from overvalued domestic tech, look toward regions like India or the FTSE 100, where valuations are anchored in physical production and infrastructure. 3. Monitor the credit cracks. Keep a sharp eye on private credit markets. As AI disrupts the cash flows of software companies, the debt used to fund their expansion is becoming riskier. If you see high-yield credit spreads widening this week, it is a signal to move your dry powder into short-term treasuries or physical gold, which has shown structural resilience in this month's volatility. Success in this market isn't about being fast, it's about being positioned where the money is forced to go next. I'm Vivian Thorne. This has been the 5-Minute Signal. Stay sharp. This program is for informational and educational purposes only. Economic strategist Vivian Thorne is not a licensed financial advisor. This content is not a substitute for professional, financial, investment, or legal advice. Always consult with a qualified professional before making any financial